It's 1776, and America is born with a fierce love for freedom, including financial freedom. For over half of its 250-year history, the U.S. had no central bank. Why? Americans didn't trust government-controlled money. But from wildcat banks to billionaire bailouts, the journey to the Federal Reserve's 12 gods who rule the dollar today was a roller coaster of chaos and power. Let's dive into America's financial story. When America kicked off, the Founding Fathers were wary of centralized power, especially over cash. In 1791, Alexander Hamilton, the dollar's mastermind, launched the first bank of the United States. It paid war debts and stabilized markets. But by 1811, Americans suspicious of government banks let it expire. Round 2. The second bank in 1816, which tamed financial chaos until President Andrew Jackson, a bank-hating populist, killed it in 1836. For decades, America ran on free banking, local banks issuing their own money. Then came 1907, the year America's freewheeling finance hit a brick wall. A stock market crash triggered a nationwide panic. People rushed to banks, demanding their savings. Banks, short on cash, started collapsing like dominoes. With no central bank to step in, the U.S. economy was on the brink. Enter J.P. Morgan, the Wall Street titan. This guy wasn't just rich. He was a financial superhero. Morgan locked bankers in his library, twisted arms, and used his own fortune to stabilize markets. He personally guaranteed loans and rallied banks to pool funds, saving the day. But here's the problem. America couldn't keep relying on one rich dude to play Superman. The Panic of 1907 exposed the dark side of financial freedom. Without a central system, a single spark could burn the economy down. Morgan's rescue worked, but it was a wake-up call. The government realized they needed a permanent fix, one that could stabilize markets without freaking out a public that hated government banks. By 1913, after 3 years of fierce debates, the Federal Reserve, aka the Fed, was born. But it wasn't your typical government bank. Americans still didn't trust Uncle Sam with their money, and powerful bankers didn't want politicians calling the shots. So, they crafted a compromise, a hybrid system blending public oversight with private muscle. The Fed consists of 12 regional Federal Reserve banks, from Boston to San Francisco, each overseeing commercial banks in its turf. These banks, technically owned by thousands of private banks, not the government. Meet the Federal Open Market Committee, or FOMC, what traders call the 12 gods of finance. These 12 members, representing the regional banks, wield insane power. Their decisions on interest rates and money supply can shift trillions of dollars globally. More influence than the president himself. Who are these 12 gods? 7 are Board of Governors members, picked by the president for 14-year terms, way longer than any elected official. The other 5 are regional bank presidents, chosen by private banks, with New York's president always in the room because, let's be real, New York runs the show. They meet at least 8 times a year, and when they do, markets hold their breath. One rate hike or cut can make or break economies worldwide. The FOMC splits into 2 camps: doves, like former Fed chairs Ben Bernanke and Janet Yellen, who keep rates low for smooth sailing. Then there are hawks, like current chair Jerome Powell, who play hardball to tame inflation. Traders dissect every FOMC member's stance because one vote can swing billions. And get this, the president can nominate governors but can't fire them. Ousting one takes a 2/3 vote from Congress. These folks are untouchable. From 1,770 SXS distrust of banks to the Fed's 12 gods ruling the dollar, America's financial story is about balancing freedom and control. The Panic of 1907 showed the cost of going too far, and the Fed became the answer: flawed, powerful, and global. Is the Fed saving the economy or running the show behind closed doors? Tell us in the comments.